How banks are bailed out under the radar. Section 1. The crisis that never ended. In March 2023, major U.S. banks collapsed within days. Panic filled the news, then suddenly disappeared. The problem looked solved, but it was not. The system did not heal. It was stabilized quietly. The reveal is simple. Banks were kept alive through emergency support hidden from public debate. Section 2. The bond trap. During 2020 and 2021, banks received massive deposits from stimulus programs. Interest rates were near zero, so banks bought treasury bonds and mortgage securities. When interest rates rose in 2022, bond prices fell sharply. Banks were left holding assets worth far less than they paid. As long as they did not sell, losses stayed hidden. Section 3. The Bank Term Funding Program. The Federal Reserve created the Bank Term Funding Program. This program let banks trade underwater bonds for cash at full face value. A bond worth $60 million in the market was treated as worth $100 million by the Fed. The difference was newly created money. This stopped bank runs, but erased real losses on paper. Section 4. Life support and contradiction. Banks also borrowed heavily from the Fed's discount window. Emergency borrowing reached levels higher than the 2008 crisis. At the same time, officials claimed they were fighting inflation. This is the conflict. You cannot remove money while adding money. Markets rose while everyday costs stayed high. Section 5. A loophole turned profit machine. Some banks found a risk-free trade. They borrowed cheaply from the Fed and redeposited the cash back at higher interest. This created guaranteed profits with no risk. The loophole was later closed, but the damage was done. Emergency support became a profit center. Section 6. Forced consolidation. When a large regional bank failed, it was handed to a megabank. The government agreed to cover most future losses. Profits stayed private. Losses shifted to the public system. This accelerated consolidation. The message was clear. Small banks would not be saved. Section 7. The commercial real estate threat. Office buildings lost value as remote work expanded. Vacancies rose above 20% in many cities. Regional banks hold most commercial real estate loans. Trillions in loans are coming due at higher rates on lower valued buildings. Many borrowers cannot refinance. Section 8. Extend and pretend. Regulators are encouraging banks to delay recognizing losses. Loans are extended instead of marked as defaults. This keeps banks appearing healthy. The cost is time. The risk spreads to pensions, insurers, and the wider economy. Section 9. The real bill. The silent bailout protects large financial institutions. It concentrates power and weakens transparency. The cost is not paid today. It is paid later through inflation and lost purchasing power. The system survives by hiding damage, not fixing it.